Today I'm going to expose exactly what's happening behind the scenes in the crypto markets. And I need you to understand this because the moves you're seeing right now are not natural. What we're watching is a coordinated crash. It's synthetic, it's engineered, and it's designed with one goal: to shake you out of your position so that institutions and whales can scoop up your assets at a discount. This is not financial advice. Now, if you've ever felt like the markets make absolutely no sense, like you're watching the charts 1 minute thinking things look strong, and then suddenly out of nowhere a massive red candle wipes out hours or days of gains, you're not crazy. That's by design. These are not normal retail-driven moves. They are structured events put in motion by the very institutions that have the most control. And the earlier you recognize this, the earlier you'll stop panicking when they flip the switch. Before I break down how these engineered crashes actually work and give you real examples that have already happened this year, I want to let you know that in the pinned comment below, I've put together something special, the XRP Millionaire Blueprint. It's a complete package that includes a document, infographic, video, and other resources that walk you through the strategies, insights, and breakdowns I personally use and study. If you want to see the bigger picture and understand how to take advantage of opportunities while others panic, check the pinned comment below for instant access. Now, let's get back to what's happening in real time. The first thing you need to understand about how these crashes are manufactured is that fear always comes first. When institutions want to cause a sell-off, they don't just dump into the market blindly. They pair it with fear headlines. You'll notice this pattern again and again. The news cycle suddenly heats up with scary stories, geopolitical concerns, threats of global conflict, economic scares. You'll hear something like the US just moved jets into position, or global tensions spike, or the Fed is signaling disaster. And at that exact same time, massive red candles slam into the charts. Here's what really happens. Retail investors see the candles, they check the headlines, and they connect the dots in their own minds. Oh no, this is because of war tensions. Or oh no, the Fed is crushing the markets again. And because they think it makes sense, they panic sell. The truth is, the news is nothing more than the cover story. The real reason the crash happens is because institutions are selling in size at the exact same moment. And here's the kicker. Those same institutions are already positioned to profit both ways. Not only do they unload massive amounts of crypto, creating these artificial crashes, but they also set up short positions in advance. So, while retail gets liquidated and flushed out of their longs, the institutions make money twice. First, from the short bets, and second, from buying back at the panic lows. Let's talk numbers because this isn't just theory. This is happening right now. Over 100 million worth of ETH longs were liquidated in just 60 minutes the other day. Across the entire crypto market, closer to $500 million worth of longs were wiped out in the same window. That's not random. That's engineered. Solana, Bitcoin, XRP. All of them got hit. And each of these flushes followed the same pattern. Engineered outflows at the institutional level, paired with panic at the retail level. Now, the tool that gives these institutions the most power right now is the ETF structure. And I cannot stress this enough. ETFs give firms like BlackRock, Fidelity, Grayscale, Vanguard, and State Street incredible amount of control over the supply and demand mechanics of crypto. Here's why. When you look at the fine print of how an ETF actually operates, it's shocking. Let's use the Bitcoin ETF as the cleanest example. If investors sell out of the ETF, that creates outflows. Those outflows require the ETF managers to sell the underlying asset, Bitcoin itself. Now here's where it gets interesting. They don't have to sell that Bitcoin immediately. In fact, BlackRock CK's rules allow them to sell any time within a 21-day window. That means if $5 billion worth of ETF redemptions came in last week, they could choose to dump all $5 billion worth of Bitcoin on the market today. Just imagine the shockwave that sends through the order books. And because they know exactly when they're going to pull the trigger, they can position themselves perfectly beforehand with short trades. One insider a tip, one signal passed from one desk to another, and billions of dollars are effectively used as a weapon against retail. This is not some far-off theory. Let's look at actual recent events. BlackRock K's iBit ETF had $1.2 billion worth of outflows, and when that supply hit the market, Bitcoin's price dropped by 10%. Fidelity had a $500 million ETH outflow. Result, a 12% crash in Ethereum. Grayscale saw $18 billion of Bitcoin outflows in 2024, leading to a 20% correction. Vanguard and State Street have had their own smaller events, but each one triggered volatility spikes that rippled through the market. And remember, these are just the big cap coins, like BTC and ETF. When you take that same ETF model and apply it to smaller cap cryptos like XRP or Solana, the effect is magnified. Lower liquidity means bigger moves with less capital. What looks like a simple wave in Bitcoin becomes a tsunami in XRP. That's the dangerous part, but also the opportunity, because while retail traders are panicking, institutions are taking the other side of every single one of those trades. And you can too if you understand the rhythm of these engineered crashes. And here's what happens next. Almost every single time after these engineered crashes, the market rebounds sharply. Look at the charts. It's clockwork. Steep dump, rapid rebound, sideways grind, and then the pattern repeats. Why? Because institutions don't just profit from the downside. They profit from both sides. They shake out weak hands. Then they let the market float back up, and they rinse and repeat. The opportunity for you is right in the middle of this cycle. Instead of panic selling into the engineered dump, you wait for the setups. You understand the mechanics, and you ride the rebounds. And when you zoom out, you'll see that the long-term direction for XRP and the rest of the market remains strong. The economy is printing positive GDP numbers. Rate cuts are still on the table. And AI integration is accelerating global efficiency. These aren't bearish long-term signals. They're just temporary manipulation cycles on the way up. Institutions rely on one thing above all else: predictable human behavior. Retail investors are predictable. When prices go up, they get greedy and pile in. When prices go down, they get fearful and panic sell. The cycle has been repeated so many times across stocks, commodities, and now crypto that it's practically hard-coded into market psychology. The reason these engineered crashes work so well is that the vast majority of participants never learn the lesson. They keep reacting emotionally to the same triggers. Here's how the cycle typically unfolds. Step 1 is the setup. Institutions quietly position themselves. This could mean building up large, short positions, arranging ETF outflows, or simply sitting on a large reserve of tokens they're prepared to unload. Nothing flashy happens at this point. The charts look relatively calm. Retail traders are often lulled into a sense of security, thinking everything is stable. Step 2 is the spark. This is when the news cycle heats up. You'll suddenly see headlines pop up in clusters. Sometimes it's political, sometimes it's macroeconomic, sometimes it's crypto-specific, but the pattern is always the same. Fear-driven stories hit the media at the exact time institutions begin selling into the market. Because retail consumes news instantly, the panic spreads like wildfire. Step 3 is the cascade. This is when prices fall sharply, stop losses get triggered, leverage traders get liquidated, and the selling pressure compounds on itself. A few $100 million in institutional selling can turn into billions of dollars in total sell pressure once retail piles on top. That's why charts look like cliffs during these events. It's not just the original selling. It's the chain reaction of forced liquidations and panic exits that magnify the move. Step 4 is the harvest. Once the engineered crash has flushed out weak hands, institutions begin buying back in. Sometimes this happens quietly. Sometimes it happens with a sudden reversal candle that erases half the dump in a matter of hours. Either way, retail is left reeling. Those who panic sold are sitting on the sidelines watching prices rise without them. Those who held through the drop often hesitate to buy more because they fear another crash. And meanwhile, institutions reload their bags at the cheapest prices. This cycle has played out countless times, but in crypto, it's even more brutal because the market is so volatile and liquidations happen fast. Leverage trading platforms make it even easier for institutions to trigger cascades because once enough longs are liquidated, the automated selling does the heavy lifting for them. Let's take a look at Ethereum's recent price action as a case study. At around $4,500, ETH was showing strength, retail sentiment was euphoric, and leverage was stacked on long positions. That's the perfect environment for a harvest. Institutions started unloading, paired with headlines about economic uncertainty. Within a short span, ETH fell below $3,500. Longs were wiped out en masse. Hundreds of millions liquidated. The cascade did the rest. And within days, ETH was trading far below levels anyone thought possible just a week prior. Now look at what happened after. The rebound was sharp. ETH clawed its way back up, providing perfect profits for those who were positioned to buy the lows. That rebound wasn't a miracle. It was part of the same cycle. Engineered crash, liquidation, harvest, rebound. The danger here is obvious, but so is the opportunity. If you understand the rhythm, you stop reacting emotionally. Instead, you prepare. You don't chase green candles at the top of the cycle, and you don't panic sell into engineered dumps. You watch the mechanics play out, and you use logic instead of emotion. That's how you stop being the liquidity and start being the counterparty. Now, let's talk about why this matters even more going forward. The ETF structure isn't going away. If anything, it's expanding. Bitcoin and Ethereum ETFs are just the start. Solana and XRP ETFs are in the pipeline. Once they launch, the same mechanics we're seeing now will apply to even more assets. And the smaller the market cap, the greater the impact. Think about it like this. A $1 billion outflow in Bitcoin might move the price by 10%. But a $1 billion outflow in XRP could send shockwaves through the market because the liquidity is smaller and the supply is easier to manipulate. Institutions know this. They're not just setting up to profit from the majors. They're setting up to dominate the entire altcoin landscape once ETFs are in full swing. And remember, they don't even have to act fairly within the exchange-traded fund structure. That 21-day window for selling outflows gives them a huge advantage. They can time their sales however they want with zero obligation to act transparently. If they want to sell all at once, they can. If they want to stagger sales to drag out a downtrend, they can. If they want to pair sales with strategic short positions, nothing stops them. And every time they do, retail is on the losing end. This is why it's so important to zoom out and think strategically. Short-term volatility will always be engineered, but long-term direction is driven by fundamentals, adoption, economic policy, technology. Right now, the fundamentals for crypto remain strong. GDP growth is positive. Rate cuts are on the horizon. AI integration is accelerating efficiency across industries. Money supply is set to expand. None of those are bearish long-term signals. They're just overshadowed in the short term by manipulation cycles. And those cycles will continue because they work. Retail has not learned the lesson. Every time a crash happens, you see the same social media posts. This time it's over. This time crypto is dead. And then just months later, prices are higher than before. The people who panic sold are left behind. And the institutions that engineered the crash are the ones holding larger bags. Let's also consider how this plays out globally. It's not just US-based institutions with ETFs, international players are involved too. Sovereign wealth funds, foreign banks, and multinational asset managers are all dipping into crypto exposure. The more of them that get involved, the more coordinated the cycles can become. What looks like chaos on the charts is actually strategy at the top levels. One of the biggest misconceptions retail has is thinking that the market is free. They believe that because crypto is decentralized, it's immune to manipulation. But price action is not decentralized. Exchanges are centralized. Liquidity pools are finite. ETFs are controlled by giant firms. The assets themselves may be decentralized, but the trading infrastructure is not. And that's where manipulation happens. The irony is that the more mainstream crypto becomes, the more controlled it becomes. Back when Bitcoin was a niche asset, price action was wild but organic. Today, with ETFs and massive institutional involvement, price action is still wild but manufactured. That's the trade-off of mainstream adoption. And it's one reason why engineered crashes are not going anywhere. Why does XRP rebound so strongly? Two main reasons. First, its community base is strong and committed. Retail panic may drive short-term selling, but long-term holders continue accumulating on dips. Second, institutions themselves want exposure to XRP because of its role in cross-border settlement and enterprise adoption. That means every engineered dump is not just an opportunity for institutions to profit short-term. It's also a chance for them to reload XRP bags for long-term positioning. Think about the long-term implications of this. If institutions are deliberately shaking retail out of XRP positions while simultaneously accumulating, what does that say about their outlook? It says they see value in holding XRP long-term. They're just not willing to buy it at inflated retail-driven prices. They want it cheap. And the only way to get it cheap is to create fear, engineer dumps, and scoop it up while retail panics. The story of crypto has always been about disruption and the removal of inefficiencies. Bitcoin started that conversation by introducing digital scarcity and decentralization. Ethereum advanced it with programmability and decentralized applications. But XRP has always charted its own path, deliberately designed for speed, settlement efficiency, and bridging institutional money flows. With an ETF approval, XRP effectively plugs itself into the same channels of trust and accessibility that drove Bitcoin and Ethereum ETFs into the mainstream. This is not just another asset, it is one that is tailor-made for the corridors of global finance. One of the most fascinating dynamics here is the ripple effect that occurs when regulatory clarity finally arrives. For years, XRP and Ripple battled lawsuits, enforcement actions, and a fog of uncertainty that made many institutions hesitate. Now, with the SEC giving its nod to an ETF, that fog begins to lift. Banks, payment companies, and remittance providers that were quietly watching from the sidelines may finally feel emboldened to step in. The narrative shifts from what if regulators crack down to what happens if we don't adopt this fast enough. That change in tone is pivotal. Consider how ETFs for gold transformed that market. Before SPDR Gold Shares, GLD, launched in 2004, gold was mostly traded through futures contracts or physical holdings, both cumbersome for mainstream investors. Once an ETF made gold as easy to buy as a stock, adoption skyrocketed, liquidity deepened, and price discovery became more robust. Today, GLD is one of the largest ETFs in the world. XRP may be about to undergo its own GLD moment. Liquidity doesn't just make prices rise, it stabilizes them, broadens participation, and accelerates the feedback loop of confidence. Another layer to consider is international positioning. XRP has long been embraced outside the US in Asia, Europe, and Latin America. Ripple's partnerships with banks and payment corridors have gained traction despite US regulatory battles. Now, with the SEC's approval, XRP gains a new legitimacy that can further amplify its adoption abroad. For example, Japanese financial giants have been openly enthusiastic about Ripple's technology for years. European regulators, particularly under my markets in crypto assets regulation, are offering clearer pathways for crypto integration. When these regions see the US stepping forward with an ETF, it validates their early adoption and strengthens the case for deeper integration. Liquidity will not only come from ETFs themselves, but also from the new derivatives and financial products they unlock. Options markets, leveraged funds, structured products. All of these tools thrive on the presence of an underlying ETF. For institutions, these products are essential for hedging, risk management, and yield strategies. For retail, they provide additional ways to participate beyond simply holding. This web of financial engineering could ultimately push XRP deeper into the financial mainstream than ever before. But there's also a paradox here worth addressing. When crypto assets achieve legitimacy through ETFs and institutional adoption, some early purists argue they lose their edge, their rebellious ethos. XRP has always been a controversial token in this regard, with critics saying it is too centralized or too corporate. Yet those very characteristics may now serve as strengths in this new phase. Institutions don't necessarily want anarchic decentralization. They want reliability, speed, and trust that the rails will function seamlessly. XRP offers that. So while Bitcoin maintains its role as digital gold and Ethereum continues to power decentralized finance, XRP can become the institutional bridge asset, a role that only strengthens with ETF approval. Volatility is inevitable in the short term. As traders scramble to price in new information, we may see dramatic swings. The approval itself is a catalyst, but the market will need time to digest inflows, arbitrage opportunities, and institutional positioning. Some funds may allocate immediately, while others may wait until volumes prove sustainable. This staggered adoption can create a rolling wave effect where price action doesn't simply spike once, but continues to experience upward momentum over time as more capital rotates in. We should also expect narratives to evolve rapidly. Already, analysts are comparing XRP's approval moment to Ethereum's ETF approval. But XRP has something neither Bitcoin nor Ethereum had at the time of their ETF launches: a direct tie-in to the world of payments and cross-border settlements. Every time an international bank integrates Riplet or ODL, on-demand liquidity, it reinforces the real-world utility of XRP. ETFs add a layer of financial legitimacy, while real-world adoption keeps strengthening the use case. This dual driver is rare in crypto, and it's one of the reasons why XRP's trajectory could diverge significantly from its peers. Now let's zoom out even further. Imagine the global financial landscape 5 or 10 years from now. Central banks are exploring digital currencies, payment networks are digitizing, and trillions of dollars in cross-border transactions flow daily. Amid this transformation, assets that are both fast and compliant with regulatory frameworks will stand out. XRP's ETF approval is not the endgame, it's the entry ticket. It allows the asset to sit at the table with the largest pools of capital and participate in reshaping how value moves across borders. Of course, challenges remain. Regulatory clarity today does not guarantee smooth sailing forever. Political shifts, evolving international standards, and new technologies can all disrupt momentum. But the ETF milestone gives XRP a buffer of legitimacy that will be hard to reverse. Once an asset is woven into the financial system through ETFs and institutional holdings, unwinding it becomes increasingly difficult. That stickiness is what investors should watch most closely. From a strategic standpoint, investors may begin rethinking their portfolios around this new dynamic. For years, crypto exposure was seen as speculative, often capped at a small percentage of overall assets. But as ETFs proliferate, we may see XRP move into the category of alternative assets alongside commodities and real estate. Pension funds, endowments, and sovereign wealth funds, entities with massive influence, may allocate in ways that shift the baseline of demand for good. Even a small percentage of allocation from these giants could dwarf the current daily trading volume of XRP. It is also worth examining the psychological shift among retail investors. For many, ETFs represent a stamp of approval. People who would never open a crypto wallet or navigate exchanges may now find themselves comfortable buying XRP exposure with a click in their brokerage account. This is where legitimacy and accessibility combine to create tidal waves of participation. The barriers that once made XRP intimidating dissolve when it sits next to Apple and Microsoft in a trading interface. History has shown us that financial revolutions don't happen all at once. They unfold in stages. Bitcoin brought the concept. Ethereum expanded the possibilities. XRP with its ETF now builds the bridge to traditional finance in a way that can integrate both worlds. Each step builds upon the last, accelerating momentum until what was once fringe becomes commonplace. We may very well be watching that transition happen in real time. It's easy to get lost in charts, price predictions, and speculation about what happens tomorrow. But the real story is much larger. The approval of an XRP ETF represents a milestone not just for one token, but for the evolution of finance itself. It signals that digital assets are no longer on the periphery. They are entering the very heart of the global system. For XRP holders and observers alike, the journey ahead will be as unpredictable as it is historic. And at this turning point where new wealth paths are being forged, those who want to truly understand how to position themselves will want to explore the XRP Millionaire Blueprint, a resource designed to help navigate exactly this kind of moment.